All right, kids. So today we will start the third session. Oops. All right. Today we shall shift our focus to the era post 1980 until 1991.
Why?
But sir, were we not going to talk about socialism? Did we? Hang on. Let me check my notes. Tell me. Did this so-called socialism work? And think about it. What are the conditions in which it would actually work? Are these conditions realistic? I decided to stick to the facts and history for the time being. I think it would be enough for anyone to judge if it works or not. Today, we shall focus on what led to the balance of payment crisis and eventually the glory years that followed.
But so why not continue the discussion on socialism?
Yes, sir. My friends are very vocal supporters of Marx and they sound very smart. I want to be able to talk to them. So I'm very confused. See, I know of a Rahul from St. Stephen's and he has a brother-in-law who buys and sells lands at a premium. And Rahul has significant investments where he turns profits, and none of this is redistributed to the poor. But Rahul talks a lot about redistributing wealth, while he also talks about Azadi. And the people my father thinks of as the smartest people on earth hail Rahul as the solution to all our problems. See, when you know the subject well, you do not really have to argue a lot. If you really know the subject, you just have to let them speak and eventually they start sounding stupid. So the most important thing is you know the subject, which is what we shall do.
But isn't it important to respond?
Yes, it is, but yelling into a camera only changes government. It doesn't really change governance. Education will change governance.
क्या बात है यार ये था ना कुछ हाँ लेकिन कैसे आता है पता नहीं कितना टक
Make a note of that. Just to help you put things in perspective, let me just begin the topic from the end of this era, that is from 1991, and then go back to 1980. So, do you know what happened in 1991?
Yes, the then Finance Minister Dr. Manmohan Singh and the ex-PM of India, Dr. Narasimha Rao, they liberalized the economy.
Yes, but why? What led to it?
Vision?
Force? Nada. Let's analyze. But a quick note before I begin. Dr. Arvind Panagariya, renowned economist and chairman of the 16th Finance Commission, says that 1991 or 92 was the crisis year. And the 1991 reforms were a response to the crisis rather than the cause of the crisis. The conventional practice creates a serious distortion by including the year 91-92 into the post-91 reform period. I'll explain. As you can clearly see in this yearly growth rates of GDP from 1974-75 up until 2003, there's a distinct dip in the growth rate in 91-92. And the oscillations leading up to that year are also very evident.
But sir, there are highs like 7.7 and 10.5, numbers we do not see post 92. So were the 80s not better?
Good question. Anyone care to venture a response?
The highs seem sporadic. Maybe there were some reforms that explain these highs, but clearly they could not sustain. Growth in the 1980s was more fragile than in 1990s.
Yep. Let's dive deeper. Raju, read the bit I shared with you from a paper authored by Dr. Arvind Panagariya and read the highlighted bit.
Yes, right.
So first, the years 1988-91, during which the economy grew at the super high average annual rate of 7.6%, are critical to obtaining an average growth rate during the 1980s, and that is comparable to the growth rate in the 1990s. Second, the variance of growth rates during the 1980s is statistically significantly higher than that in the 1990s. In this sense, growth during the first period was fragile relative to that in the second, and indeed, it culminated in the June 1991 crisis. So whichever way you look at it, growth rates between 1980s and 1990s were comparable. Good. Now, Meek, read up the highlighted bit I shared with you.
consider for a moment annual average growth rates until 1987-88. If we take the 10-year period from 1978-79 to 1987-88, the average growth rate is an unimpressive 4.1%. In 1988, anyone looking back at the 10-year experience would have concluded that India was still on the Hindu growth path. Even limiting ourselves to 1981-82 to 87-88, which is 6 years, we get an average growth rate of only 4.8%, which is strictly below the growth rate of 4.9% achieved during the fifth 5-year plan, which is 74 to 79. Had it not been for the unusually high growth rate of 7.6% during 1988 to 91, we would not have reason to debate whether the reforms of 1990s made a significant contribution to growth.
So what changed? Let's dive deeper into what led to this spike. Here we look at the two main factors, liberalization and borrowings and public expenditure. And let me set some context, which takes us back to the previous era. So after 1947, India relaxed import controls through the open general licensing list. That is, we allowed certain items to be imported without the need for individual licenses, and this helped trade and economic growth. The first 5-year plan, that is 51 to 56, marked a period of progressive liberalization. This policy aimed to address the immediate post-independence need for industrial and infrastructural development by making essential machinery and raw materials more accessible. Then, in 1956-57, a foreign exchange crisis ended this liberalization, and we went back to restoring comprehensive import controls until much later in 1966. In June 1966, there was a lot of pressure by the World Bank on India to devalue the rupee from 4.7 to 7.5 per dollar, which is 57% devaluation. Now, devaluation is usually done to improve exports. However, at the same time, it also makes importing more expensive and increases inflation. Therefore, the government also introduced liberalization of import licensing, which means tariff cuts that would help in procurement of industrial input. But they also wanted to remove industry's dependence on financial assistance and improve the fiscal health, and therefore, they also reduced export subsidies. I know this is a lot of jargon, so let's take an example of India and Germany. Assume India imports machinery from Germany and exports textiles. When India reduces the value of the INR, India's textile becomes cheaper for Germany to buy, as they now have to pay lesser USD or Euro for the same item, at least until the market increases the price of the goods itself. Now, this means Germany can buy more textiles from India and India earns more foreign exchange because of cost competitiveness. However, now India also needs machines to make these textiles. But devaluation also means that India needs to pay more INR for every dollar, and therefore importing is now more expensive. Import licenses and tariffs make it worse.
क्या चाहते हो? बच्चे की जान लेना चाहते हो? चाहते क्या मुझे बता दो?
So India reduces tariffs and licensing controls to make this easier for textile manufacturers. But the textile manufacturers in the country have been dependent on subsidies for exports that artificially made textiles more competitive in the market. That is, government subsidizing excise duties or import duties for items that are being exported. Now, this was gone. So it needed textile manufacturers to be genuinely competitive and more productive. Overall, while this was a nudge in the right direction, by 1968, domestic backlash led India to revert to the inward-focused policies. You see, there were structural issues that ran very deep. Our agricultural productivity was very low and industrial sector was very inefficient as well. So reduction in subsidies did not really help at the time. Now, going back to the textile example. Textile manufacturers in India stopped getting government support, whereas their competitors in other countries, let's say Bangladesh or China, would keep receiving support and had lower production costs. Moreover, now the industry was more pressured to improve productivity and therefore quality suffered. So these reforms were driven by demands set forth by foreign aid givers, like the World Bank and others. So politically, this was very difficult to position for a government which was about to face elections. Again, quoting Dr. Arvind Panagariya, almost all liberalizing initiatives were reversed and import controls tightened. This regime was consolidated and strengthened in the subsequent years and remained more or less intact until the beginning of a period of phased liberalization in the late 1970s. Industrialists started to find the strict regime highly counterproductive. They were struggling with high production costs, poor quality, aging capital stock, and overall technological backwardness. Even industries with comparative advantage like textiles, leather, cotton were affected. Intense lobbying and some increases in remittances from Indian labor, which had started to go to Middle East and send money back to India, it started to pave way for liberal policy making. The pace for reform picked up significantly only after 1985, and that's when GDP grew at an annual rate of 7.6% from 1988 to 89 to about 1991. Exports, which had grown annually at a paltry 1.2% rate during 80 to 85, registered a hefty annual growth of 14.4% during 85 to 90. Hari, read up the categories of reforms in this phase.
For sure. So the OGL list, it was steadily expanded and reintroduced in 1976 with 79 capital good items, which grew to 1007 in April 1987, 1170 in April 1988, and 1329 in April 1990. OGL imports rose from about 5% in 1980-81 to about 30% in 87-88. Items added to the OGL list often received tariff reductions or exemptions. The listed items were mostly machinery or raw materials without domestic substitutes, significantly contributing to increased productivity. Secondly, there was decline in the share of canalized imports.
Canalization refers to the monopoly rights of the government for the import of certain items. So, for example, petroleum products. The Indian Oil Corporation, or IOCL, was often responsible for importing crude oil and petroleum products. For fertilizers, certain fertilizers were imported through agencies like Fertilizer Corporation of India. For food grains, the Food Corporation of India, or FCI, managed the importation of essential food grains to ensure food security. Reduction in commodities specified for canalized imports resulted in significantly expanded room for imports of machinery and raw materials by entrepreneurs. Hari, continue.
Sure. Thirdly, there were several export incentives which were introduced or expanded, especially after 1985, which also helped expand imports directly when imports were tied to exports, and indirectly by relaxing the foreign exchange constraint. In the 1985 budget, 50% of business profits attributable to exports were made income tax deductible. In the 1988 budget, this concession was extended to 100% of export profits, which means no income tax on export profits. The interest rate on export credit was reduced from 12% to 9%.
Right. So, for example, if an exporter borrowed 1 million rupees or 10 lakh rupees at 12% interest, the annual interest payment would be 1,20,000 rupees. Reducing the interest rate to 9% lowers the annual interest payment to 90,000, which saves 30,000 rupees annually.
Right. In October 1986, duty-free imports of capital goods were allowed in selected thrust export industries. Again, in April 1988, a list of capital goods was increased in the OGL. Exporters were given an assurance that the incentives announced in the export-import policy would not be reduced for a period of 3 years. There was significant relaxation of industrial controls. Firstly, in 1985, 25 industries were delicensed, increasing to 31 by 1990. The investment limit for no industrial license was raised to rupees 500 million in backward areas and rupees 150 million elsewhere, with specific urban distance requirements. Previously, licensing applied to firms with fixed capital over 3.5 million rupees. 27 major industries remained subject to licensing regardless of investment size or location, including coal, large textile units, motor vehicles, sugar, steel, and many chemicals. Products under small-scale industries reservation were excluded, though the asset ceiling for SSI units increased from 2 million to 3.5 million rupees. Broadbanding, which allowed firms to switch production between similar production lines such as trucks and cars, was introduced in January 1986 in 28 industry groups. In 1986, firms that reached 80% capacity utilization in any of the 5 years preceding 1985 were assured authorization to expand capacity to 133% of the maximum capacity utilization reached in those years. Again, the asset limit above which firms were subject to MRTP or monopolistic and restrictive trade practices regulations was raised from rupees 200 million to 1,000 million. There was price and distribution controls on cement and aluminum which was entirely abolished in this era. Finally, the multi-point excise duties were converted into a modified value-added or MODVAT tax.
Wait, what?
Which enabled manufacturers to deduct excise paid on domestically produced inputs and countervailing duties paid on imported inputs from their excise obligations on output.
Right. So, consider a company manufacturing electronics. Let's say their raw material cost is 1,000 rupees and excise duty on raw material is 12%, which is 120 rupees. Now, total cost of raw material becomes 1,120 rupees. The manufacturing cost is 400 rupees. The total cost before excise on final product is therefore 1,520 rupees. And excise duty on final product is another 12%, which is 182.4 rupees. Now, credit for excise duty paid on raw materials is 120 rupees. Therefore, net excise duty on final product is 62.4. So the final product cost is 1520 plus 62.4, which is 1582.4. Without MODVAT, the excise duty would have been 182.4, leading to a higher final cost. So the MODVAT system thus reduces the overall tax burden, benefiting both manufacturers and consumers.
Yep. Finally, the fifth thing was the realistic exchange rate.
So Panagariya in 2003 pointed out that low and declining barriers to trade constitute a necessary condition for sustained rapid growth. So kids, at a high level, we have analyzed what led to the spikes of high growth rates in 1980s. Now, let's look at the borrowings and public expenditure and what eventually led to the balance of payment crisis. GDP grew at an annual rate of 7.6% from 1988 to 89 to about 1991. Exports, which had grown annually at a paltry 1.2% rate during 80 to 85, registered a hefty annual growth of 14.4% during 85 to 90. There's a distinct dip in the growth rate in 91-92.
What is balance of payment crisis?
Balance of payment crisis occurs when a nation is unable to pay for essential imports or service or pay off its external debt payments. Now, during the 1980s, investment to GDP ratio increased in the public sector while it reduced in the private sector. However, growth rate of public sector fell. And it likely helped raise the total GDP growth rate indirectly by contributing to the rise in the growth rate of private sector output. Raju, read up some of the data that I've shared with you. Yeah, so external borrowing helped bridge the gap between exports and imports. Yet, owing to initial disparity, RBI trade data shows imports to GDP ratio exceeded exports to GDP ratio by 2.5 to 3 percentage points throughout the 1980s. Higher imports were partially financed through external borrowing. Foreign borrowing boosted growth but rapidly increased foreign debt from $20.6 billion in 1980 to $64.4 billion in 1989-1990. Long-term borrowing surged from $1.9 billion annually in the period of 1980 to 85 to $3.5 billion annually from 85 to 1990. There was more short-term borrowing. External debt to GDP ratio rose from 17.7% in 1984-85 to 24.5% in 89-90. Debt service ratio increased from 18% to 27%. The debt service ratio is a financial metric that compares a country's total debt service payments, including principal and interest, to its export earnings. So, it measures the proportion of export income that is used to service external debt. Therefore, a higher debt service ratio indicates that a larger share of the export revenues is being used to repay debt, which can signal potential issues with debt sustainability and overall economic stability. Debt quality deteriorated. Private borrower share rose from 28% to 41%, non-concessional debt from 42% to 54%, and average debt maturity fell from 27 to 20 years. While aiding growth, the rising debt pushed the economy towards a crash. While this was happening, internal expenditures were rising too. Defense spending, interest payments, subsidies, and higher wages of the Fourth Pay Commission drove expenditures. In early 1980s, expenditures averaged 18.6% of the GDP. In the late 1980s, this rose to 23% of GDP. And the major contributors were defense, interest payments, and subsidies, which increased from 7.9% to 11.2% of the GDP. Continued large deficits of this magnitude led to a buildup of very substantial public debt, with interest payments accounting for a large proportion of the government revenues. They also inevitably fed into the current account deficits, which kept rising steadily until they reached 3.5% of GDP and 43.8% of exports in 1990-91. And the eventual outcome of these developments was the June 1991 crisis. As per Professor Aditya Bhattacharjea, the deteriorating fiscal situation was exacerbated by the political instability that followed the electoral defeat of the Rajiv Gandhi government in 1989. Growing current account deficits deteriorated into a full-blown crisis when the Gulf War of 1990 led to a spike in oil prices and a fall in foreign exchange remittances from migrant workers who had to be repatriated from West Asia. This depleted India's foreign exchange reserves to the point where they could barely cover 2 weeks' worth of imports. The political economy had also undergone a transformation. And what it led to is history. Seemed like we'd be going back to living the Malgudi days. In words of former governor of RBI, Rangarajan, the total loan raised against the pledge of gold was $405 million. In today's reckoning, it may look very small. It's not even equal to what we get sometimes in the form of capital flows on a single day. But that amount was crucial at the time to prevent a default. There was no intention on part of the RBI or the government to hide the transaction from the public. RBI wanted to make it public once the operation was over. Otherwise, there was some operational risk. The shipment of gold brought out loud and clear the extremely critical situation in which India was placed. It also brought home to everyone the enormity of the crisis. In a sense, it paved the way for the reforms that were to come. Alright boys, let me stop our session here today. We shall look into the 1991 reforms and the period thereafter in the coming sessions. Boys, read up about the reforms for the next class. See you.